Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you'd like the lowest rates at the lowest costs, reach out to me. I'd like to meet you, and that is for sure. Here is this week's mortgage market at a glance. Several developments are converging on the global economy and financial markets at the moment. Each brings its own causes for concern. Together, they bring a significant increase in volatility. Answering such questions is beyond the scope of this video. What I can say is that the financial market is clearly asking itself this question, and the effects are obvious. Stocks had been flat in the weeks leading up to the Omicron, and bonds had been moving higher in yield. Post-Omicron, they've entered into a familiar risk aversion pattern marked by lower stock prices and bond yields. The same risk-off vibes are apparent in other assets as well. COVID may not be the only consideration for oil prices, but it did give them a push. Lower oil prices don't dictate rates, but they have bearing on inflation. Lower inflation is good for rates, all other things being equal. So at the very least, lower oil prices aren't hurting rates. The Federal Reserve is increasingly saying yes. Just this week, Fed Chair Powell dropped several candid comments during a scheduled congressional testimony. These weren't out of left field by any means, but they surprised more than a few market participants. So what did they say exactly? Well, in a nutshell, Powell acknowledged that we should no longer be referring to high inflation strictly as a temporary byproduct of COVID-related supply disruptions. That's important because it suggests the Fed needs to be more aggressive when it comes to doing something about it. The second comment followed naturally from the first when Powell said the Fed may need to taper more quickly, which is fancy words for buying fewer treasuries and MBSs, by the end of the week. By the end of the week, multiple Fed speakers made similar comments. Suddenly, the market is gearing up for the strong possibility the Fed announces an acceleration of its tapering process as early as the December 15th meeting. Well, yes and no. The goal with faster tapering isn't actually about tapering. Rather, the Fed's playbook calls for finishing asset purchases before raising rates. And raising rates is what the Fed would really like to be able to do in the fight against inflation. In other words, faster tapering is a means to an end. The Fed's rate hike outlook affects shorter duration bonds first and foremost. After all, a 2-year Treasury note is a lot closer to being an overnight rate, like the Fed funds rate, than a 10-year Treasury note. To be fair, the Fed rate hike expectations hit longer-term rates as well, but longer-term rates get much more benefit from things like the Omicron concern. As such, longer-term yields were able to continue lower at the end of the week, even as the Fed rate hike expectations continued higher. The only catch is that mortgage rates haven't weathered this storm as well as 10-year Treasury yields. Not really, but at the same time, they've gotten the shorter end of the stick relative to 10-year yields. There are a few reasons for this. The simplest reason is that the average mortgage doesn't tend to last 10 years. That means from an investment standpoint, mortgage-backed bonds are often more comparable to shorter-term debt like 5-7-year Treasury yields. In fact, one popular analytical practice is to blend the 5 and 10-year Treasury notes to serve as a better basis for comparison on mortgage bonds. If I compare mortgage rates to 10-year yields, I might be more concerned about the recent underperformance. But if I make the same comparison with 5-year yields, mortgage rates have actually done better over the past few months. That's a topic of much debate and unavoidable uncertainty. As has been the case since early 2020, so much depends on the course of the pandemic. Omicron simply increased uncertainty and widened the gap between positive and negative outcomes. If things go well from a global health standpoint and Omicron fails to become as damaging as this summer's Delta wave, rates would likely move higher. In the opposite scenario, the downward pressure on rates would take its cues from the severity of the situation. More lockdowns and global economic upheaval equal lower rates, generally speaking. We'll cross those bridges if we come to them, though. It depends on whom you ask, but this week's biggest news for the housing market was likely the official announcement of the new conforming loan limits for 2022. We knew they'd be big, and now we have confirmation. The new loan limit raises to $647,200 for 2022, quite a jump from $548,250 in 2021. So there you have this week's mortgage market at a glance. If you'd like to know more, reach out to me. I'd like to meet you, and that's for sure. Thanks for watching, and if you're looking to purchase or refinance a home in Arizona, I would like to be your broker of choice. Till next time, take care, stay safe.